Hey traders, welcome back to the channel. Today, we're diving deep into a topic that is the absolute bedrock of technical analysis, support and resistance. If you've ever felt like the market reverses right after you enter, or you're constantly getting stopped out just before the price moves in your favor, then this video is for you. Mastering support and resistance will fundamentally change the way you see the charts, giving you a powerful edge in your trading. So grab a coffee, get your charts ready, and let's get started. First things first, what exactly are support and resistance levels? Think of them as price floors and ceilings. Support is a price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. As the price drops toward support, it becomes cheaper, and buyers are more inclined to step in, which can push the price back up. Conversely, resistance is a price level where an uptrend can be expected to pause due to a concentration of supply or selling interest. As the price rises towards resistance, sellers see an opportunity to take profits, which can push the price back down. These are areas, not exact lines, where the psychology of the market shifts. So, how do we find these crucial levels on our charts? The most common method is looking for historical price action. Look for swing highs and swing lows. A swing high is a peak where the price turned back down. Connect multiple swing highs, and you have a potential resistance level. A swing low is a valley where the price turned back up. Connect multiple swing lows, and you have a potential support level. The more times a level has been tested and held, the stronger it's considered to be. Don't just look for one or two touches. We want to see significant price reactions at these points. You can also use other tools like moving averages, trend lines, and Fibonacci retracements to identify dynamic support and resistance. But for today, we'll focus on these horizontal price levels. Let's pull up a chart and identify some together. Here on this daily chart, you can see the price came down and bounced off this area multiple times. This is a clear support zone. Notice how I'm drawing a zone or a box, not a single line. Price rarely respects a single pip-perfect line. Now, look up here. The price struggled to break above this area on several occasions. That's our resistance zone. These are the battlegrounds where bulls and bears fight for control. Identifying them is the first step, but how we trade them is where the real magic happens. There are two primary ways to trade support and resistance: the bounce and the break. The bounce strategy is simpler. You buy at support and sell at resistance. The idea is that these levels will hold, and the price will reverse. So, when the price comes down to a strong support level, you'd look for signs of buying pressure, like a bullish candlestick pattern, and then enter a long position. Your stop loss would go just below the support zone, and your target would be the next resistance level. It's a classic range trading strategy. But what happens when these levels don't hold? That's where the second strategy comes in: the break and retest. This is my personal favorite and often provides higher probability trades. A breakout happens when the price pushes decisively through a support or resistance level. For example, if the price breaks through a strong resistance level, it signals that the buyers have overpowered the sellers, and the uptrend is likely to continue. The old resistance level now often becomes a new support level. This is a concept called role reversal or polarity. Here's the key to the break and retest strategy: patience. Many new traders jump in the moment a breakout happens, only to see the price snap back. A painful move, known as a fakeout, or a liquidity trap, is designed to trick traders into thinking a breakout is occurring. Big players might push the price just above resistance to trigger all the breakout buy orders and the stop losses of short sellers, creating liquidity for them to enter their own large positions in the opposite direction. Then, the price reverses, trapping all the breakout traders. To avoid this trap, we wait for the retest. After the price breaks through resistance, we wait for it to pull back and test that old resistance level from above. If it holds as new support, and we see the price start to bounce off it, that's our confirmation. This is a much safer entry point. You'd enter a long position after the bounce is confirmed. Place your stop loss below the new support level and target the next logical high. This confirmation step filters out a huge number of fakeouts and dramatically increases your odds of success. Let's walk through a real-world example of a break and retest. Look at this chart. We had a clear resistance level here, tested 3 times. Then, we see this strong bullish candle break right through it. The amateur trader buys right here, at the top. But look what happens next. The price pulls back. This is the retest. It comes right back down to our old resistance line, which now acts as a floor. See this bullish pin bar forming right on the level? That's our entry signal. We enter long, place our stop loss just below this new support zone, and ride the trend upwards for a beautiful, low-risk, high-reward trade. That's the power of patience and confirmation. The same logic applies to a breakdown of support. If the price breaks below a key support level, we don't immediately short. We wait for the price to pull back up to retest that old support level, which should now act as new resistance. If it rejects that level and starts to fall again, that's our high probability entry for a short position. Your stop loss goes just above the new resistance, and you're targeting the next support level down. Remember, trading is a game of probabilities, not certainties. No strategy is foolproof, and support and resistance levels can and will break. That's why risk management is non-negotiable. Always use a stop loss, and never risk more than you're willing to lose on a single trade. By combining a solid understanding of support and resistance with the discipline of the break and retest strategy, you can filter out market noise, avoid common traps, and find high-probability setups. To recap, identify key support and resistance zones by looking at historical price action. Wait for a clear break of a level, not just a small poke. Then, be patient and wait for the price to retest that level from the other side. Once you see confirmation that the level is holding in its new role, that's your signal to enter. This simple, 3-step process break, retest, entry will keep you out of so many bad trades and put you on the right side of the market more often. Start practicing this on your charts. Go back in time and identify these setups. See how they played out. The more you train your eyes to see these patterns, the more intuitive it will become in live trading. That's all for today's deep dive into support and resistance. I hope you found this incredibly valuable. If you did, please hit that like button and subscribe so you don't miss our next video. Drop any questions you have in the comments below. I'll do my best to answer them. Thanks for watching, and happy trading.